All right. Hi, everyone. My name is Kaylee Shaver, and I'm the marketing specialist here at RKL eSolutions. Thank you for joining us today as we host LeaseQuery for a webinar on how to build your lease portfolio. On the line from LeaseQuery today is Ben Belt, a CPA who joined their technical accounting team after working as a senior auditor at a major accounting firm, where he led the engagement team through SEC findings of quarterly and annual results and guided clients through the adoption of new standards. Just a few housekeeping items before we get started. All lines are muted, but we encourage you to enter any questions you may have throughout the presentation into the Q&A feature located at the bottom of your screen. All questions will be answered at the end of the presentation, and the session will be recorded, which we'll send out to you in the next couple of days. All right, Ben, go ahead.
All right, good morning or good afternoon, everyone. Glad to be with you guys today to talk through how to assemble the lease portfolio from the perspective of somebody that's been helping do it for hundreds of clients at this point, because obviously this year is the year to make everything happen for ASC at 42 from a compliance perspective. So this conversation primarily is going to focus on what to do, say, prior to the decision of how to actually manage all of the lease data and kind of what solution that you pick. Of course, LeaseQuery is one of the vendors here that has a cloud-based solution for just the accounting part of the leases. We really built the entire tool, just for accounting compliance to be able to manage everything from disclosures to journal entries, et cetera, within everything to do with your lease portfolio. So we'll just kind of go through here. It's about a 30-slide presentation just to give you an idea of the timeline, shooting for roughly 45 to 50 minutes. And then at the end, I can talk a little bit about what comes after all of this, but the majority of the conversation will be here today just on, before you actually pick where you're going to put all this stuff, essentially how to get it together, which is what we find to be the hard part for most of the people we work with. So first, I would like to give a little bit of background about us. We were started in 2011 as our founder was looking for a less manual way to account for leases. George Z, he worked at a Fortune 500 company, which, he was on the accounting team as one of the accountants, of course, and had the responsibility of the entire lease portfolio back under ASC 840 when everything was cash and expense. And he went to market because the company that he worked for had 300 or 400 leases and were looking for a way to kind of keep them all together that managed it a little bit better than Excel. Of course, accountants all take pride in their ability to manage their beautiful Excel spreadsheets, and maybe we all have our own unique ones that we like to keep up with, but we hope not to make leases part of the inventory of Excel spreadsheets and instead offer something that's a little bit easier to use. So in short, George went to market, couldn't find anything. And to summarize it all up, we now offer lease accounting solutions for FASB, IFRS, and GASB. So all the public private sector entities, international and in the US. And for GASB, we can actually account for GASB 87 leases and the upcoming GASB 96 SBITAs, or subscription-based IT arrangements, which is basically the same leasing framework as applied to things like LeaseQuery. If you had a subscription to our software, which was over what would hopefully be an indefinite period of time. So the LeaseQuery story as of today, current state, is that we have around 2,000 plus customers. This is actually growing, by the day. We had an additional 80 come on just this past month. So we're actually closer to 2,400 in total right now. Maybe we need to give that an update next time around. But of those, we have leases in 93 countries. We have retained 99% of our clients. And the only reason we cannot claim 100 there is because we've lost some due to carve-outs or acquisitions with other entities. So there's nobody that has ever switched from our product to another. And something that we'll get into a little bit further on the next slide as well is the average satisfaction rating for people that currently use our product. So if we go to the next slide, I'm sure everyone here has bought things online before and leaned heavily on current user reviews to get an understanding of how well something will work for the use case that you need it for before you actually take the risk yourself with the purchase. So G2 is a website which does for software exactly what Amazon does for consumer goods. This report is a compilation of all of the user reviews for us and our competitors in the space, where you see that we lead the market in overall satisfaction with functionality on the x-axis and also market presence on the y-axis. So of course, more market presence means that we have to be even more consistent and accurate with the actual functionality itself to retain the satisfaction score for a larger user base. So we are very proud of this. We have over 70 user reviews on the G2 website, all of which are positive, that average out to a 4.5-star rating from clients and auditors that actually use the tool now and have done so for years. So if you would like, user reviews from current people that are on the systems right now to be part of your decision-making process in the solution that you pick, please feel free to go read those at the G2 website. Give me a second here to take a sip of water. All right, and now a little bit about me. I know that we already got a brief intro at the beginning, but in short, I'm a CPA in North Carolina and Georgia. I have a couple of accounting degrees from prior to when I started working, of course, and I spent some time at Deloitte, about 3 years, and ended up bailing on the audit team right before my senior busy season, which would be the first one that was remote. So hopefully that's understandable. I've enjoyed life outside of the public sector a little bit more so far, but in short, lease accounting is my area of technical expertise. I did a lot of the 842 adoption work with Deloitte when I worked there and helped write some of the implementation guides, et cetera. So if you guys have questions throughout, feel free to throw those into the chat and we will monitor those and bring them up if there's kind of a theme, or maybe just address them at the end. But hopefully I'll be able to give you a complete understanding of what all goes into the transition to 842 prior to, again, actually picking a solution. So that gets into what we are going to talk about today. Just very brief overview. We're going to talk about what a lease is and how to define them and some of the scoping requirements there. And then once you have a sense of how to communicate what a lease is to other team members, we'll talk about how to gather all the data, how to build the lease inventory, best methods of tracking those things. The third part here will be the actual validation of the completeness and accuracy of the lease inventory. This is probably one of the harder parts, but there are some ways that our software itself can actually help make sure that you have a complete and accurate listing of everything that you've got. And then last, we'll talk about some of the nuances and some of the lease accounting policies that you guys would choose or elect prior to actually putting lease data into a solution like LeaseQuery. So we're going to take a breather here for a minute and fire up the first of 4 poll questions and just ask you guys, how do you currently plan to, or how did you, if you already have, comply with ASC 842? And I guess I'm seeing choice 1 and choice 2 here. So if that's what you guys are seeing as well, let's go with choice 1 is going to be some form of Excel or manual upkeep, and choice 2 can be software.
Yeah, thanks. Sorry about that. I did put those answers in, but apparently Zoom did not save.
No worries. The content here is the most important part, so we'll be good. So we'll give you guys about a minute or so to wrap this up. All right, so hopefully that was helpful. If there are, results or anything that were published that you'd like to share that I could comment on, okay, there we go. So choice 1, 80% some form of manual entry or being able to keep up with it on your own, and choice 2, looking at software. So appreciate the votes there, and keep in mind we got 3 more of those coming up, which will take little breaks from the very heavily technical rest of the slide deck. So on to slide 7. What is a lease? So the definition I'll start with, we're already pretty familiar with the basic lease definition of what a lease represents, which is essentially paying for the right to use assets owned by another party for a specific period of time. ASC 842 does place a new emphasis on the concepts of what an identified asset actually is and when the lessee actually has the right to control that asset. So the ASC 842 definition of what a lease is a contract or part of a contract, such as in the case of an embedded lease, that conveys the right to control the use of an identified PPE or identified asset for a period of time in exchange for consideration. That is the quick and dirty in short. So first, the most important piece here is the concept of having an identified asset, which requires considering substantive substitution rights and things like this. If the supplier has, if the lessor or the person that's giving the lessee the equipment in a lease fashion has substitution rights, then the customer doesn't actually have the right to use a specific identified asset, and thus the arrangement is not accounted for as a lease, but more like a generic rental or maintenance type agreement under one of the other frameworks. And in order for the supplier to have substitution rights, both of the following criteria must be met. The first is that the supplier has the practical ability, to substitute an alternative asset through the period of use. And the second is that the supplier would somehow economically benefit from exercising that right to actually do the substitution. So what we're talking about here is a situation where the supplier has the unilateral right to switch out the asset for a different one, and the benefit of doing so outweighs the cost. An example of this could be copiers. These are generally smaller in size, and the vendor typically has an inventory, a lot of excess of the same type of copier available that they could switch out so that they can work on yours if it's broken or something for the time being. So in some cases, leases of copiers, if the vendor can substitute it in a way that would benefit their business, would not actually be a lease. Another concept that we wanted to highlight briefly here is the emphasis that ASC 842 places on control or possession. The word is even included in the formal glossary definition now. A customer is considered to have the right to control an asset if they have the right to obtain substantially all, in quotes, of the economic benefits from the asset, and they can direct the use of that asset. So legacy rules under 840 primarily focused on the economic benefit criteria, but under 842, we now have to think about what is the purpose of the asset, which party controls those decisions, and that's what we mean by control, is basically we have a greater emphasis on that specific piece under the new rules. One other real life example of this is that under 840, there was a 4-part criteria test to determine whether a lease should be considered capital or operating, but under 842, there is now a 5th part, which is specialized use. If the asset that you guys have leased from another party has some specific thing that could not make it easy to switch to a different entity after that period of time, then the specialized nature of that would make it count as a capital lease, for example. So this is where judgment comes into play a little bit. The standard does not set a specific definition for substantially all or provide an inconclusive checklist to follow. So some of the factors to think about when you're performing this would be, what is the purpose of the asset? Does the customer have the right to dictate when, how, where the asset is used? Often a lease arrangement will be pretty clear cut, but more analysis and thought is needed, especially when identifying embedded leases, which are components of an existing contract. So these are the 2 pieces. I guess I could have pulled those up at the beginning so that we had those boxes up, but identified asset and right to control are the main 2 pieces that we're thinking about under ASC 842. So on the next slide, since we're talking about scoping overall, it's important to mention here that there are specific types of things that some people are not sure whether they should count as leases or not, but they would be scoped out of ASC 842 and accounted for under a different accounting standards codification. So the most common examples that we see that people actually get tripped up about when they're in the contract gathering phase would be intangible assets like goodwill and other things. Those will continue to be accounted for under ASC 350. If there are rights that you have on a piece of land to explore, X period of X property, which even if you have exclusive rights to do that, you're just maybe mining minerals or oil and gas from things like this, which we see a lot of the time with, of course, oil and gas companies or some manufacturers if they need that as part of their normal business operations. Those things would be extractive activities, as in those 2 ASCs that are highlighted right there. Biological assets, including timber, or things that are kind of renewable, are not technically considered unique, distinct assets like that. So those would be accounted for under ASC 905 for agriculture. Inventory in general is something that you guys just own. So ASC 330 inventory, and then assets under construction, such as PPE, with the exception of things like build-to-suit leases and stuff like that. But if you guys are modifying stuff, and even in the case of some leases, if they are behaving as a lessee asset, if you pay to improve the property, then that would actually be considered not a lease or not a lease component. It could be parsed out. So assets under construction are another big piece, but I would say the most common one here that actually comes up most often would be intangible assets. So also we could talk about embedded leases a little bit. These are the types of arrangements where it is not always so clear that they actually meet the criteria of a lease. With an embedded lease, you're talking about a contract where the primary transaction is not necessarily related to a specific asset, but the terms of the arrangement actually convey the customer a right to control a specific identifiable underlying asset. So embedded leases are not new. They've been around for a while and companies were required to identify them even under the old framework, but they're getting greater scrutiny and consideration now because of the new requirement to present operating leases on the balance sheet. In the past, since operating leases were off balance sheet arrangements, not identifying all of the embedded leases did not pose a material risk to accuracy of the financial statements because it was just cash and expense regardless. So companies should now consider their policies and processes around reviewing contracts for embedded leases and make sure that they are robust enough to comply with ASC 842 requirements and essentially not miss anything. So your whole organization, not just the accounting department, needs to be trained on what to look for in a contract so that even when a lease is not immediately obvious, it will still be identified. One of the hardest parts about being on the accounting team in general is that often accounting is the last to know about stuff like this. So overall, a big theme of today's presentation is going to be that education to other departments who might be more on the business side of these transactions or on the sales side that are getting the contract submitted might still want to share more information with the accounting team than they otherwise would have had to under ASC 840. So when you are reviewing your contracts to determine if they are in scope for 842, it may be helpful to develop some sort of checklist with the type of scoped out agreements like intangible or biological assets or inventory, but also a checklist of the positive criteria for identifying whether or not a contract actually contains a lease, such as what is the contract type? Is there a specific asset? Do we obtain the right to control that specific asset? Do we have substitution rights, et cetera? So to help you get started, we actually have an embedded lease test. I don't know that you guys are able to access this right now during the presentation, but we will share the deck with all the links included after the fact. And things like this, which we will link throughout, can be accessed by you guys at that time. So on the subject of the embedded lease test, here are a couple of screenshots from our version of this tool, which just show kind of how we get walked through the process on the website and then get a document that actually presents as audit evidence. Is this contract, does it or does it not contain an embedded lease? So at first, we're going to ask you to name it, essentially give it a unique identifier, which is important from a LeaseQuery perspective as well. If we're actually entering lease data into the tool, then we need to have some way to make it distinct. So name your embedded lease first. And then after that, we'll get into the identification test. Is the asset explicitly specified in the contract as a unique serial number that you've actually got? And thank you, Kaylee, for throwing the embedded lease test into the chat. If you guys would like to take a look at that right now, the link is in there. And then next, also part of the identification test, does the supplier have substitution rights? And on the other end, do you have substitution rights? And then is the asset physically distinct? So there's a lot more questions to be answered here as we go through the control test, and then you ultimately get the results. But just wanted to show a couple of screenshots from this so that you guys know that it's one of the many things you can use for free on your way to transition, even if you don't choose LeaseQuery as a vendor. So on to the next slide. This is going to be kind of a link dump here, but we have a bunch of transition resources that are designed for, again, the pre-signature part of this implementation of the new standard. We have a transition guide to ASC 842, which is basically a checklist or an action plan, which takes the steps explained in the transition guide and turns them into a roadmap of the different tasks that actually need to be completed. And then we have the transition checklist itself, which goes in tandem with that and actually outlines the timeline for all of those things. And then second two things, these are just a couple of blogs. Myself on my team and the other folks that I have on my team all basically rewrite the ASC 842 guidance as applied to the real world and just put them in blog posts. So we have two here that are really relevant, one of which is the lease accounting transition advice from the experts, and second of which is how to transition to 842, a step-by-step guide. So sort of like a online, easily viewable version of the transition guide and the checklist. Overall, I mean, the biggest amount of time in implementation of a new standard is just making sure that you've gathered all the data, as I will probably emphasize a few times. So please use these tips and tools and resources to help. And ultimately, just know that they're free to you, again, regardless of what you pick. So here, I'm going to take a quick breather, and we're going to fire up the second stage or the second polling question. Hopefully this one will come up with 5 options here, which, okay, perfect. So what stage of the lease implementation process is your organization in? I'll let you read the choices here, and then we'll have a little bit of discussion depending on what the poll fills out as. All right, so here for poll 2, we have pretty much what I would have expected, which is that you guys are both, or everyone here is in the early stages of the process right here of assessing what needs to be brought together, which means you're in the right spot at this presentation right now, or consolidating and collecting lease accounting data. So it seems like basically we're concerned about completeness again in general for these things. So I'll be sure to emphasize that as we go through. So closing that out and on to the next slide. This is the second of the 4 sections that were outlined in the agenda. We're on slide 13, just to give you guys a checkpoint. And what we're going to talk about now is how to build your lease inventory. So a couple of tips, which you're welcome to read through here. But again, to reemphasize, compiling the lease inventory is by far the most time-consuming and resource-intensive part of transitioning to the new lease accounting standards. But by breaking up the task into smaller, manageable steps like we have in the transition checklist and using our resources as well, which again are free to you right now, and following some simple tips learned from other transitions that we have been through with over 2,000 customers at this time, then the process becomes a little bit more manageable. So we'll spend the next several slides reviewing the steps to gathering your lease portfolio together, which ultimately are what we are actually seeing occur in the real world. So, in short, the hardest part of this is that the accounting team really does have to reach out proactively to all these different departments that they may not normally interact with on a day-to-day basis. So it's helpful, of course, to have some kind of management directive there so that people pay attention to your emails, et cetera. It just requires a lot more logistical coordination than it otherwise might for this one in particular. So in short, what we're going to go through is to create a complete inventory of all your leases. You have to first obtain listings of all of the leased assets from every entity, department, location, et cetera. You have to go through and scrub the accounts payable records and see what all recurring payments are in there to make sure that there's nothing hidden that would relate to a lease. And then you get copies of all those contracts from, again, all the entities, departments, locations, et cetera. Evaluate each of them to determine if they are in scope under 842, and then determine what class of underlying assets that they would actually fit into, so that you have an idea of your, say, pie chart split of where the cash goes each month by asset type. Then you will pick a materiality threshold, ensure all the appropriate contexts are included in your inventory listing, communicate all the preliminary conclusions, critical estimates, and policies with the auditors, and kind of go from there. So it's a pretty straightforward, pretty easy to intuit how it would all come together. But again, we've been through this many, many times, and we can show you in the next couple of slides what this actually looks like in the real world. So the biggest thing that I emphasized at the beginning here is that you guys, many different departments are involved essentially, and will need to collaborate to make finding all the leases and having a complete list a success. So a good first step is to identify which departments to actually talk to, such as the ones mentioned on this slide. We've seen leases from every one of these different places, many of which don't often accumulate or communicate rather with the accounting team. And then identify a contact person in each of these spaces, provide a little bit of training and education to these contacts early on, just so that they understand what ASC 842 is and why it's imperative for the business to make sure that this is done correctly from an accounting perspective, and then why identifying the entire lease portfolio is critical to getting that done. So this also gives you the chance to educate others about embedded leases and what kinds of things to look out for when reading contracts to make sure that they are identified correctly. And honestly, in the real world, you would be surprised how many people come to us from an accounting perspective thinking that they have identified all their leases, and it ends up, tripling or times 10, sometimes even after we've done the paperwork. For example, the way that we price our software is based on the number of leases that you have. So sometimes we'll enter into a relatively small contract with someone and they'll be like, oh, wait, we forgot about these 600 leases. And we'll be like, oh, well, that's going to change things a little bit. So let's go back to the drawing board again. So the completeness assertion, again, is one of the most important things to consider after pulling all this together. Within LeaseQuery, one of the advantages to having software to actually help with this is that we are also able to run historical framework reports under the ASC 840 set of rules so that you could look back in time. And that's a great way to do a completeness check, just to make sure that everything is in software or within your central repository of lease data, which is supposed to have been based on prior year disclosure. So one of the other things that we can send you guys a link to, or again, be referenceable from the deck after the fact, is the leased asset tracker. You have to make sure once you get all the contracts together that they all go somewhere, even if you haven't gone through the whole buying process for getting software at that time and don't have a central repository to put it in. We do have a leased asset tracker that you can use in the interim as kind of a placeholder in for that period of time. So there's several data points that are needed to measure the ASC 842 liability and asset balances properly, and using a standard lease tracker template as we offer on the website. And again, thank you, Kaylee, for that link, is a way to quickly identify any data that you might be missing. So you could get a contract, for example, that's missing like a unique identifier for each asset, or maybe a location for a building or whatever else. And these are all things that we have to be able to ultimately present the 842 data as required. So it's just helpful to know if you're missing critical pieces of attributes right there. Especially, we see a lot of times very decentralized organizations that have a lot of different locations or departments. So a good way to do this is to use this template for each of the departments or locations and send it to all of them to fill out, so that you then have some kind of idea of the different inventory for leases that they've got. If every location uses the same template, it'll be a lot easier to compile the data into one listing and then analyze or run different reports after you've gathered everything. So hopefully those two things are helpful. From here, moving on to slide 17, which is the intro to the third part of the 4-part presentation, validating the completeness and accuracy of the lease inventory. So we're going to go through a few things here. First, again, on the completeness, I hate to beat a dead horse here, but this really is the most important part. And now we're getting into the accuracy section a little bit as well. So after you've got all the contracts into the lease inventory, when you think you've compiled your complete listing of leases, there are a couple ways that you can ensure that your lease contracts are all included in your lease portfolio. So the first one is to compare or reconcile your actual physical contract copies with the leased asset listings that you get from separate sources, i.e. the actual vendor or the lessor. do you have a contract for each of the listed assets, or are some missing, either assets or contract copies? So this is just a basic, just like a cash reconciliation between book data and bank data, just to make sure that they've all got the same stuff in there. And then compare your final lease listing with the 5-year lease commitment schedule that you prepare annually for reporting. So does your lease inventory reflect all of the leases on the schedule? Lastly, you have to actually look at the dollar amount of the rent expense to also prove if any contracts may or may not be missing. So extrapolate your annual rent expense from your final lease listing using the payment info from the contracts. And for what it's worth, at this point, you've already done the majority of the compilation data that would be required to put contracts into LeaseQuery. So again, you don't necessarily have to take the time to gather all this and then input it into something else. You could do both at once if you had a software solution and just have a place to compile everything, which also gave you the accounting outputs. But I mean, the rest of this is pretty self-explanatory for the most part, but reconcile that amount to your total annual rent expense from all of your rent accounts, and then see if the total actual rent expense is larger than the extrapolated amount that you estimated would actually be incurred over a current year. So if it is larger, then this might indicate that you have found a significant number of embedded leases, which you could verify if that's the case by going through in a little bit more detail. And then one last little pro tip here is that these amounts don't need to reconcile exactly, but if they reconcile directionally, or if they're in the ballpark, they can just give you a sense of whether or not you've included all of your leases, and if you may have a small step for the auditors to take their testing just to like miss a couple of numbers here and there that are maybe smaller, versus if you have, say, missed an entire department that would contain lease data if those things are not reconciling quite right. So this is where it gets to be a little bit more wishy-washy perhaps, but at the end of the day, they have to be accurate as well. So this is also a very important part, of course. So now we will fire up polling question 3. How would you describe your current understanding of ASC 842? All right, so you're either an expert or know a lot with some questions, or familiar at a high level, or are kind of lost. Roy, I see that you submitted a question in the Q&A. Is there a threshold for capitalization of a lease under ASC 842? This is one that we'll have a slide to get to in a moment, and I'll touch on that for sure. But in short, yes, there can be, but you guys would pick that at the company level. And what we see in practice most of the time is that people apply the same fixed asset methodology as to leases. So if you have a threshold to consider for capitalization of fixed assets, look at that for leased assets as well. The only additional complication for 842 is that you have to look at asset groups as a bundle instead of each individual thing. So if you have 2 or 3 copiers, that may be immaterial, but if you have 500, then even if they're all tiny, you would have to come up with a liability and right to use asset for the aggregate of all of those. So good question. Hopefully I can fully land the plane once we get back. All right, so here we have, I am familiar at a high level, and honestly, I'm kind of lost. So in short, I can definitely back up a little bit and provide some more context for what the standard is doing at a high level. If you guys have, the 2 of you that voted here that you're kind of lost, if you have questions, please, again, this is your time. So feel free to put those in the chat. And if we've got time at the end, I can rewind and try to give you more context overall for what this is doing. I have some good examples just top of mind that I'd be able to share that might help. So if you are kind of lost, let us know. That is why we are here. But we can keep moving through here with the 4th part of the 4-part presentation and talk about some of the lease accounting policies. So in short, after you guys have gotten all the lease data together and maybe picked a solution or not, you have to make a couple of elections on the back end that apply portfolio wide to everything and elect what you actually do at the individual lease level, how much detail to maintain the data in. So we're going to go through some of the common things that people have the options to choose between, what the pros and cons are of each, and why, or I guess what we've seen most in practice. So practical expedients are essentially just a cost savings method that apply to private companies only for adoption of the standard, which allow you to skip part of the steps that might be intuitively within the data gathering phase right here, if it would be too expensive to actually figure all this stuff out, depending on the nature of your leases. So there is one package of practical expedients that have to be elected as all 3 or none. And this one in particular is that, 1, you do not have to reassess lease classification. So you don't have to look back at if your leases should have been operating your capital historically. You could just carry them forward as you were accounting for them previously. The second, also on the top line, is not to have to reassess initial direct costs. So in the past, if you have just booked an initial direct cost that you incurred as an expense, and even though under 842, the unamortized amount of the straight line amount of those direct costs over the lease term might have a little bit left, you don't have to bring that back into the fold midway through the term if you've been ignoring it previously and just expense that. And then last is the reevaluation of embedded leases. So if you've already been through a bunch of contracts to see if they had embedded leases or things that were omitted, you don't necessarily have to go back through and dig all that up again if you already chose not to in the past. So the package of practical expedients has really only pros, which is just that it reduces the amount of time spent reevaluating things for the transition specifically. And if you do not elect it, then the cons in that case would be that you have to reevaluate every lease. You have to reevaluate all the existing or expired leases that may contain embedded ones or omitted ones. And then you have to reassess all the initial direct costs, which may lead to an equity adjustment, ultimately increasing the right of use asset balance at the time of transition. So that is the first decision, is do you want all these three things or do you not? And then the second one is one that can be elected by itself or not, which is, do you want to combine lease and non-lease components? This expedient allows lessees and lessors to account for every lease or non-lease component as a single lease component. So for example, in the LeaseQuery software, we have a section for base rent, which every lease has. And we also have a section for variable payments or additional payments, which could be things like maintenance on a vehicle or common area maintenance, taxes, insurance on a real estate asset. If you elect this practical expedient, then say you get an invoice at the end of January for one of the vehicle contracts that you have, and it's a total of $1,000, 800 of which is for the base rent and 200 is for, the standard maintenance, which is part of the contract. What this practical expedient says is that you could just lump those together as a $1,000 base rent payment, which makes it a little bit easier, save some time, especially if you apply different elections by asset class within the portfolio. And then the one con to this is that it produces a higher opening balance sheet liability and asset balance because, of course, more cash on the front and more cash over the payment terms, even discounted, is going to increase more than just the base rent itself would. So again, if there's questions there, or if I missed something, feel free to put them in the chat and I can try to clarify. But if not, we'll go through to the third election. This is not as much a practical expedient as just a decision that you have to make. So discount rates or borrowing rates is a big part of what happens at transition. I have a way that I kind of think about this, which is a little bit easier to perhaps understand than however the slide might be trying to organize it here. So in short, private companies have three basic options, one of which is take the incremental borrowing rate, or rather the implicit rate from each individual contract. If it's disclosed, it's very easy for equipment leases, et cetera. And, obviously you can just use the rate that is disclosed, but most often, especially for real estate leases, et cetera, those things are not explicitly identified in the contract because they represent the lessor's rate of return. And most of the time, lessors don't want the lessees to know what amount of money they're being made, right? Their rate of return. So the first option is to figure that out for every contract and then apply it at the individual lease level differently at lease commencement or at transition, the later of the two. And that is the most expensive and difficult and likely the one that is not going to actually happen. So the two that are outlined on the slide are the two alternatives to that, which are available to private companies. You can use a risk-free rate, which is the other end of the spectrum. It's the easiest, the simplest, but it also likely would result in the lowest rate. So you're going to have a much higher lease liability balance if you pick that, although it would save some time from a data input perspective. And in the real world, we typically see that, for example, for government entities, they're actually not allowed to use the risk-free rate. So this is not something that auditors are typically liking people to actually apply to the lease portfolio because leases are not risk-free. So at the end of the day, this is maybe not the best, most accurate rate to use, but if you've got like one person doing the entire thing on your team and you have 10 different types of assets and there's just not the time, then that is an option. And then the best option, which is the hybrid approach between the two, is the IBR, or the incremental borrowing rate. What you do is you just go out to a bank and you present them with one of your leases and you say, hey, if I were to get a loan which was structured just like this lease, what interest rate would you charge me to have a loan that was structured that way in the same geographical area over the same time period for the same type of asset if I put that up as collateral? And then you can apply that by asset class. So that's actually a recent rule change, is that previously if you picked an IBR rate, you had to apply that portfolio wide, but the FASB got together around December of last year and decided that they could make it one step more accurate or more comparable perhaps, and allow you guys to pick by asset class what an incremental borrowing rate would be. So you could have 3 or 4% for real estate assets, 6 or 7% for equipment or vehicles, and then it just makes it all a little bit more accurate from that perspective. So discount rates are a hot topic, lots of questions around that. I probably could have done a webinar, just on that overall for an hour. But again, feel free to throw some questions into the chat if you feel like I missed anything there. But in short, what most private companies land on is going to be the incremental borrowing rate. And the most accurate way to apply that is by asset class within the lease portfolio. All right, so having a full listing of your organization's leases will help when you're setting certain accounting policies, right? So you have all the data that you need to analyze the financial impact of different accounting policies. For example, many companies choose to use a materiality threshold under their ASC 842 operating lease accounting. So Roy, this speaks to your question a little bit. You may adopt a reasonable capitalization threshold below which right to use assets and lease liabilities will not be recognized on the balance sheet. So that would be applying a capitalization threshold, but similar to your asset capitalization threshold, just like I brought up earlier, that's the methodology that most people would actually apply to this, but it has to be determined independently of your asset capitalization threshold based on facts and circumstances of your portfolio and its impact to your operations. So they're basically saying, start with that, but think about it a little bit more if the threshold should be different. If you have 25% fixed assets and 75% leased assets, maybe your capitalization threshold should be a little bit higher. For leases, just take the normal facts and circumstances as part of that and make a decision that's reasonable. So when determining an appropriate threshold, you should leverage the lease inventory listing that you've already been putting together to help you identify the lower dollar value leases and then figure out where to draw the line, especially by asset class. You could do this as well. So keep in mind that if your organization has a larger quantity of lower dollar value leases, then your materiality threshold analysis should also consider whether scoping out all of those leases as a bundle would actually materially impact the balance sheet. So again, you have to look at both the individual assets and the groupings of assets by type. So choosing a threshold early in the transition process will allow you to limit the amount of resources that you spend accounting for and maintaining low dollar value and thus low impact leases. Roy, I guess if you wouldn't mind, just let me know if your question got answered there or if you've still got anything else that you'd like to talk through. But this is the way that materiality gets applied. It's basically pretty subjective and has to be substantiated like anything else. So there are a couple of other ways that things could be out of scope of technically ASC 842. What we really mean by that, like everything is still a lease under ASC 842, but some of the things do not have to actually be capitalized. Also, thanks, Roy. Saw that you got your question answered, so that's great. So the two ways that leases could be leases still that are under scope of 842 but not have an asset or liability balance is the materiality exception that we just discussed, which is a little bit gray. There's some subjectivity to it. Or there is the short-term lease exception, which is actually provided by the guidance as to how you should think about those things. So leases with terms of 12 months or less, including any periods that you're reasonably certain to renew at lease commencement, will be considered short-term leases. And you can also elect whether or not you would like to take the short-term exception by class of underlying assets. So, for a more complete listing of all this stuff, you can go back into that blog post that we mentioned earlier, but you can elect to keep short-term leases off the balance sheet. There's really no reason to elect not to do that. Like I've never seen any company take short-term leases and also capitalize those because it would all be short-term liabilities and it just doesn't make as much sense. But this is not to say that, again, short-term leases don't have to be accounted for under ASC 842. There are still disclosures required for the aggregate cash payment of all the short-term contracts. You still have to calculate the straight line rent expense for each lease, regardless of whether it's determined to be short-term. So again, this is an accounting judgment, but it's a little more cut and dry because you have an actual line in the sand that's being drawn by the FASB, which is 12 months or less. And then you can scope these out from the capitalization perspective of 842, but they are still leases that need to be accounted for. All right, so as with the lease portfolio stage, revisiting your accounting policies and procedures is really the last step here. So before you begin inputting all the lease data into a solution, you want to finalize your different accounting policies and processes and maybe write some sort of memo to bring that all together, because I'm sure the auditors would want to be able to see that. So will you use a materiality threshold for determining which leases are in scope? If so, this could save a significant amount of time on the front end by not having to enter everything, especially if you have a significant number of low dollar value assets. And then will you separate out the lease and non-lease components? This will be needed to decide beforehand so that you can put the lease data in accordingly to the policies that you establish, i.e. will it all be just base rent, or will you want a base rent section parsed out from variable payments or maintenance or different other components of the same lease contract. And then you also want to consider the accounting policies and processes for all of the day two or post-transition accounting. Putting a little bit of thought into these early in the process is going to save a lot of time and effort further down the road. So of course, there's a lot going on all at once, but these are all things to think about: the input, the review, the approval of new leases and lease transactions, and also decisions regarding what software solution, if any, that your organization choose. So who will be the administrator, what team members are going to input and change or approve lease data, how will the various roles be defined? These are relatively simple questions to answer, but often haven't been thought about when people are deciding what to do with the data that they've already compiled. So answering these upon setup will help the day two accounting to be a walk in the park compared to the marathon that the actual transition was altogether. As with anything, prevention is better than abatement, right? So planning now helps with the execution later. So in short, again, after we send out this deck, you'll be able to access these things, but this is another way to get to some of the more commonly utilized tools and free resources that we mentioned today. So we have a podcast series about ASC 842 transition steps. This is actually something that, not surprisingly, doesn't get a ton of traffic. So if you guys would like to be some of the first listeners to the podcast series, if you want to consume some Spotify lease accounting material, then you're welcome to go eat up that. And then we have the ASC 842 transition checklist as well, the leased asset tracker, which we looked at a screenshot of, which was that Excel file a few slides back. And of course, the embedded lease test as well, which again provides actual audit evidence that you can just give to the auditors for whether or not something should count as a lease. So that brings us to our final polling question. We'll try to get full participation from all the attendees here. We've gotten roughly half on the previous one so far, but yes or no, would you like a demo of LeaseQuery? All right, so thank you for the feedback on that one. We'll be sure to reach out to those of you that said you were interested about learning more. That brings us to the last slide, which gives you the link, which again, we will send out in the deck after the fact, that says, if you would like to schedule a demo, here's your $500 coupon. From here, we have about 15 minutes left in the hour that we agreed to originally. So again, this is your time. I'm going to give you guys a couple seconds to reflect on everything that we just went through and consider if there are other questions that you would like me to answer right now from, again, a CPA's perspective who's been doing lease accounting for the better part of 3 years. So what I'm going to do now is transition to the second part of what I would just like to talk through at a very high level, which is what the actual implementation timeline for a software like LeaseQuery would actually look like. And then if you guys have technical questions or anything else, I'll just ramble on for the next couple of minutes. And if you want to go ahead and put those in the chat, I can bring them up and talk through as I get to the end of this kind of tail end discussion. So in short, the implementation part is broken down into really two phases, one of which is the actual setup of the system itself. So that's something that normally takes 2 or 3 weeks on our end, just to make sure that all of the practical expedients that we went through are chosen appropriately based on what you guys want to see, that we could put things like your organizational structure into the tool, et cetera. And then after that first 2 or 3 week period of time, you guys would then have a version of the tool that is stood up and ready for you guys to be trained on and put the lease data into. At the end of the day, implementation as a whole ends up taking about 60 to 90 days, depending on the portfolio size. We have clients with 1 lease or 2 leases, and we have clients with 10,000 or 15,000 leases. So of course, the data migration itself and getting everything into the tool in a way that's complete and accurate is the biggest hurdle to overcome there, and what takes the most time and is the most variable. But in short, you could expect, roughly 100 leases, which is about the average portfolio size for our clients here right now, maybe a little bit more, like 110 or 120, but they normally take about 90 days, 60 to 90 days to get fully implemented, from essentially signing the contract to having a solution built up with all of the data in there. They can run reports and journal entries under ASC 842. So again, the front end, which is pulling all the data together, is the part which is hard and the part which people feel most rushed about. And basically we can work with whatever kind of implementation timeline that you guys need on the back end once you pick a solution. So again, I'll keep an eye on the chat for the next couple of minutes here, but if nothing comes through, we can give you guys back 10 or 15 minutes of your day, and just thanks for the time. Kaylee, anything else that you'd like to say to close?
No, it looks like that's it. If there's no more questions, thank you everyone for joining today. Thank you, Ben, for this very informative presentation. It was very good. As we said before, everyone, this recording will go out later on in the next couple of days that we'll send to you, along with the links included and the individual slide deck that you will get.
All right, good deal. So from here, if you guys have questions, or if you want to learn more, or if you want to meet with one of us to go through what we can offer to help, then reach out to your RKL eSolutions contact and we can take it from there. But thank you guys again for the time and attention today, and good luck with ASE at 42.
Thanks, everybody.